What's up, everybody? Joe Brown here. This is the Heresy Financial Show. We've got to have a talk about real estate. Right now, everybody in the country is concerned about real estate. Mortgage rates are skyrocketing. They continue to chug higher and higher every single day. We are starting to see buyers dry up because they can't afford it. And at the same time, prices are still increasing, which seems paradoxical, but it's happening. The question on everybody's mind is, will it continue? Are we going to see a repeat of 12, 13 years ago? Are we going to see the real estate market collapse? Ready? Let's dive in. All right, guys, just in case you don't know, on pretty much every video, I try and put a chart up on the screen behind me that has something to do with what the video is about. And if you ever want to guess what the symbol is, what the stock is, or the index or whatever it is, just comment in the section below. And before I say the answer to this one, let me know your guess. Pause the video if you don't want to hear it. And the answer, the stock on the screen behind me, is Redfin, symbol RDFN. Not a pretty looking chart. All right, now take a look with me at this chart. This was tweeted out by Lynn Alden at Lynn Alden Contact on Twitter. This is the 30-year fixed rate mortgage average in the United States. And one thing that you'll notice at the very end here, what we're experiencing is a massive, massive spike. And so basically what this chart shows is the change from a year before. And we are obviously experiencing a massive change because when COVID hit, and 2020 happened, and the Federal Reserve stepped in, the government stepped in, mortgage rates plummeted, and that led to a massive surge in home prices, but mortgages came down very quickly, led to massive affordability, and since then we've seen a massive surge in interest rates for mortgages, and so the change is massive. The change, because before it was a change downward, now it's a change upward. And so we are seeing a massive increase in interest rates. Now, we know this is important to keep in mind because everybody is very fearful about real estate right now. It's very important to remember that interest rates, mortgage rates, only affect people who, number one, have adjustable rate mortgages, and number two, people who are looking to buy. An increase in mortgages does absolutely zilch, zero, nada for anybody who already owns a home and has a fixed rate mortgage on it or owns it in cash. Doesn't impact it whatsoever. So if you own a home, whether you paid cash, whether you have a mortgage on it, and it's a fixed rate mortgage, it does not matter to you whatsoever what the housing market does at all. It could go up, it could triple, it could quadruple, it could go up 10x, it could drop by 90%. As long as you can still make your payments on your mortgage, on your taxes, and maintain your property, you keep your house. Now, that's the big question. Everybody says, oh, well, a drop in the housing market, that means that a whole economy is going to be crashing, and so people are going to be losing their jobs and dropping their income. That's a whole nother story. You know, I think there's economic hard times ahead of us, but the real estate market lags behind those things. That's just the truth. Real estate takes a long time to move. And so by the time you start to see people losing their houses because they can't afford to make their payments anymore, we're going to have many months of massive job loss, massive income loss, things like that, stock market crash, all of that. You're going to see these things happen way ahead of time if that's where we end up. So when you're looking at this chart that shows mortgage rates spiking, it does not matter to you unless you're looking to buy a house, because then that house will be more unaffordable to you because the interest portion of your payment is so much higher. So what does this mean for home owners? It means nobody is going to be selling their homes, right? Because if you can't upgrade for the same price, or if you're going to have to sell and move down and downscale and move into a smaller house or a worse neighborhood, and your payment would stay the same, you are not going to move. You're just going to stay where you're at. And this is exactly what we're seeing. We're seeing supply still be extremely limited because nobody's moving anymore. It doesn't matter that home prices are going up. It doesn't matter that interest rates are going up. Nobody's selling. And so all of the people who are wanting to buy, they're still having to choose from a smaller and smaller pool because nobody else can afford to move. They locked in their rate, they locked in a low mortgage. Now, the other thing to keep in mind here is demographics. We have a massive demographic problem where there are a lot of millennials and Gen Zers, and some even older millennials that do not own homes yet because they have PTSD from growing up and watching their parents lose everything. So we had an entire generation basically that said, once they were able to afford a home, they just said, I'm going to wait for the next crash. And guess what? It still hasn't happened. So you've got a ton of buyers waiting on the sidelines. They've gotten locked into renting and they can't move out to another place to rent because their rent goes way up because in most places, the rent that they're staying at can only increase by a certain amount if you're going to renew the lease. So a lot of these people are stuck, locked in, renting the place that they're living. That presents a floor underneath real estate prices, because if home prices start to collapse, now suddenly it's cheaper to buy a home than it is to keep paying rent where you're at. So what this means is that we have a supply issue overall of places to live versus people who want a place to live, because we know rents are still going up. And if we had an overabundance of places to live, you can't have both home prices going up at the same time as rents are going up, at the same time as interest rates are going up. That's not possible. You would have one or the other be going down. And so we have rents right now acting as a floor underneath housing prices, because as soon as home prices come down to the point where this entire generation will be able to move into a house and it will be cheaper to have a mortgage instead of paying rent, they're going to do it. They've been waiting on the sidelines for 10, 15, sometimes 20 years, and they will be the ones to start buying these houses. Now, back about what I was saying before about supply, about people not moving. Tighter and tighter supply with same demand means higher prices, or at least same price. At least that's a bullish force. And so these higher and higher mortgage rates that we're seeing, it has not, at least yet, had the impact of people, so few people buying that it starts to drive prices down. Now, the last thing that I'll talk about is that even if, like I was mentioning earlier, even if we get a massive economic crash, even if we have a stock market crash, banks start falling over, massive inflation numbers in goods and services, and we see all sorts of economic hardship, real estate moves a lot slower than those things. What happened last time the economy crashed? The government bailed it out. Through the use of the printing press at the Federal Reserve, they monetized a ton of debt and bailed out the economy. Do you think that those in power will allow the long-term wise thing to happen when it is short-term painful? No, they're not going to stay in office. All they care about is their own money and power. They're going to do the things that benefit themselves in the short term for their money and their power. Things that will drive asset prices higher, not lower. They will not allow deflation to happen. They will not allow a deflationary death spiral to happen. They will not allow a deflationary deleveraging to take place. We will get more of the same. They will bail it out. They'll stop the prices from dropping. The way that they'll do that is by buying stocks this time. They'll buy a bunch of government debt, driving interest rates along the curve down to zero. They'll buy a bunch of mortgage-backed securities to drive mortgage rates down to 2%, maybe 1%. They will do yield curve control. They will roll out universal basic income, probably through a central bank digital currency. Through an app, they'll say, download this app, you'll start getting $1,000 a month. They will put out all the stops. This will stop prices from crashing, and it will send prices much higher. And at that point, we might have to have a talk about the risk of hyperinflation. We're not there yet. Hyperinflation is 50% a month. We're not there yet, but it is very possible that in the way that the central bank and the central government, the Fed and the government, handle the next crash, then we do have to worry about hyperinflation. What that means for prices is that prices go up. That means that there are a lot of people who are waiting on the sidelines to buy things with fixed rate debt that are assets whose price goes up from inflation, and at some point they will be locked out of home ownership forever. Because if the cheapest house in the country is selling for $3 million, $5 million, $10 million because there's been so much inflation, incomes can't keep up with that. Now, can incomes keep up with inflation a little bit? Will they trail inflation? Yes. Do they keep up or exceed on average inflation? No. But if you've got a fixed rate mortgage, if you got a fixed interest rate debt on a asset, on a piece of property that increases in price, then your increased incomes will help you pay that off. We've seen over the last year, incomes went up 5, 6, 7%, January, February, March. Opposite, actually. I said that out of order. We saw incomes go up. Was it enough to keep pace with inflation? No. But things like mortgages don't increase with inflation. They stay the same. So the more inflation you get, the more incomes go up, the more fixed rate debt gets easier and easier and easier to pay off. It'll get to the point where many people who have mortgages that locked in, especially at those low rates a year ago, 2 years ago, many of those people in a couple of years will be looking back and saying my car payment is now larger than my house payment. And a little bit after that, they'll say my grocery bill each week is more than my mortgage. And anybody who has not yet bought will be getting to the point where they no longer have the ability to enter the market. Now the kicker here, the final straw, the final thing that I think is very possible is a 40-year mortgage. We just saw another Federal Reserve president or ex-Federal Reserve official, I can't remember who, but somebody associated with the Fed just came out and made another push for a 40-year mortgage. Now, we saw that idea was floated when COVID first hit in 2020, but it never came into fruition. It never actually happened. They pushed it and said, hey, in the dealing with the forbearance and all that, we might restructure to give people the ability to go into a 40-year mortgage. It didn't actually materialize. So you can bet that if real estate prices are crashing, which makes up a massive portion of US GDP. And if prices everywhere are crashing and they need to give people a boost, you can bet they will give people a way to refinance to a 40-year mortgage. Lower that payment. Lower that interest rate, free up a ton of cash for spending. You know they're going to give people that option. That's a final kicker that I think is very possible that comes in the fallout of the next crash. So again, I will keep you updated if I see anything different come out over the next couple of weeks, couple of months as time moves on, but there's still not anything that I'm looking at that makes me fearful of a massive real estate crash. As always, really appreciate you guys. Thank you so much for watching. Have a great day.